Michael, I always enjoyed our conversations. You and I always were talking about the great economy that we had been seeing, the jobs that we had been seeing, but it's a different picture now. And you feel that what we're seeing now is more of a bear market rally, not out of the woods yet.
Exactly, Nicole. I am an eternal optimist, perma bull, but this is ugly. What is going on with the U.S. economy right now? It's so bad, it's very difficult to quantify. Not only did you have an awful industrial production number today, you had a pretty bad retail sales number today, but once you take autos and gasoline out of it, we're only down 3.1%, which I think means that there's still some things going on. The stimulus checks are going to be coming. The excess unemployment insurance, as well as the SBA lending. So that's going to put a multiplier in the economy. So what I'm thinking is that this recession and the contraction in the second quarter is not going to be down 30 or 40%, probably somewhere between 15 and 20. But what I also think is that it's going to take us a lot longer to put the pieces back together. A lot of small businesses have closed that are never opening their doors ever again, and we won't know about that until sometime this summer. While all this is hanging out overhead, it becomes very difficult to put any sort of predictions with any sort of accuracy onto earnings. So when you have that, it's a hard. If you don't know what earnings are, how can you assign a multiple to that? So I think we've got some choppy waters ahead. But what I would say on the positive side is that unemployment peaked in March of 2010 after the last recession, but stocks bottomed in March of 2009. So we will probably get a move higher in stocks, far ahead of the bottoming in the economy and the recovery in the economy. However, I don't think that's just yet. I don't think we're out of the woods. I think historically we've always tested these bottoms after these rallies. And this is one of these times where the technical analysis and the fundamental analysis perfectly collide. So I think we've got choppy waters ahead. I don't think we're out of the woods. I ultimately think we'll make it through. It's going to be difficult for, again, a lot of these small business holders, a lot of these people on the fringes, retail workers, Best Buy furloughing 50,000 employees today. This is going to be difficult for them, but we will get back to it. We will put the pieces together.
So I know you're looking at staples and things that are a little more defensive. I mean, cyclicals you're leaving for later. You'll tell us when you're going to consider getting into some of those cyclicals. But for right now, you're positioned very defensively. You're talking about staples, utilities, treasuries, cash. What's the allocation? Are you very heavy in cash, or how are you doing it now? So because you also don't want to miss a move up either, right, Michael?
Yeah, so I've got like roughly 35% in the long bond and the TLT, another 20% in cash, 5% or so in technology, and another 10% in healthcare. So technology and healthcare are kind of my growth assets if we get a runaway here. But then also, 10 to 15% of utilities, 10 to 15% in staples, depending on where the market is this second. But that's kind of my allocation right now. And then what I see is as we approach that 2,200 number on the S&P 500, depending on how it looks, do we break through that? Do we bounce off that? I'll be ready to flip the switch. I'll probably cut that treasury exposure in half, take that cash down to sub 5%, and start moving into consumer discretionary, bigger allocations to tech, add XLC, which is the communication sector, maybe even some basics and some industrials. But really just flip the switch almost. Sure.
Yeah, I was going to ask you about the ADR that you mentioned.
Yeah, TeamViewer. This is a really interesting story. Some people may know it as a competitor to LogMeIn123, but what it is it's a virtual desktop, and it uses a handshake technology. So instead of everybody working from home, trying to log into their company's cloud through their own pipes, through your local internet, through your local desktop, what you do is it's a screen share to your work desktop. And what that allows major companies to do is protect the security, protect the speed, and not have everyone accessing their cloud from a million different directions. This is a little known company because it's a German company, but I'd say the technology and the security is far superior to that of a Zoom or a lot of these other places. It's cheaper, safer, and easier to use than a Citrix for a lot of people that are working from home. So I think this work from home technology is also something that's here to stay, regardless of the coronavirus. A lot of people are extremely effective that way. Real estate is an unnecessary expense for a lot of companies. So this team viewer, I think, is going to work. On full disclosure, I'm waiting till I tell everybody on all my media hits that I like the stock, but I don't own any yet, but I will over the next month in my kids' accounts.
All right, good to know. Just quick, you think we'll get back to Dow 30,000 by 2021? Our earlier guests thought so.
Yeah, that's that's tough. If not 2021, 2022, because what's going to happen on the other side of this is rates are going to be low. We're going to have record fiscal stimulus. And as a result, you're going to have very high multiples on stocks. I think it's probably going to take a little bit longer than your previous guess, but we're definitely going to make new highs in the market. It's a matter of when, not if. I think it may be a little bit longer off, but again, the key part for investors watching is that the market will move ahead of the economy. The market is not the economy. The market is a forward predictor of the economy. So before this virus went off the rails, the market sold off really fast, really hard. And like in the last recession, we weren't out of the woods until sometimes in the middle of 2010. Market bottom in March of 2009. So stay invested, look for names you like. Obviously, I'm going to get more aggressive as things get lower. Have a lot of cash now, but we're going to get through this.